Let's say you have an inherited IRA and you're forced to take a required minimum distribution under the new 10-year rule from the Secure Act. What should you do with it? We're going to go over a tax planning idea coming up next. Hey, this is Mel Stubbs. I'm a financial planner here at Christy Capital Management, and today we're going to go over a tax planning idea. So let's say that you have an inherited IRA, and under the new rules of the Secure Act, you have to take a required minimum distribution during the first 9 years and then a complete distribution in year 10. Now keep in mind you cannot do a Roth conversion with an inherited IRA, but there are some other tax planning ideas that you can do. So what about this? What if you did a Roth conversion on your own personal IRA? You chose not to pay the taxes out of your IRA money, but instead used the required minimum distribution from the inherited IRA to pay the taxes on that Roth conversion. Let's go over an example. Let's say you inherited a $200,000 IRA from someone who was not your spouse. You are required to take a minimum distribution in the first 9 years and then take the full balance out in year 10. Well, the first question is to figure out, do you want to take out the minimum amounts for 9 years and then take out a really large amount in the 10th year? Or do you want to split it up and take out 10 equal payments? Because remember, the distribution is taxable. So doing 10 equal payments may work out cheaper in the long run than doing 9 payments and then a really large payment in year 10. This is an instance where you want to look at your tax bracket and your taxable income and figure out what's best for you. For this example, we're going to use the 10 equal payments. Let's say for this example that your account is growing at 5% a year. And so you start off with $200,000. You take out 1/10 of that, which would be $20,000 for the first year distribution. The remaining $180,000 is going to grow at 5%. In the first year, when you take out $20,000 distribution, you have to pay taxes on this. So for this example, let's assume you're paying 22% federal, 5% state taxes. That means that after you pay taxes, you'll receive $14,600 that you could use to pay taxes on a Roth conversion on your own IRA. So to do the math, if you're still assuming that you're in the 22% federal, the 5% state, that means you could do a $54,074 Roth conversion. The taxes that would be owed on that $54,000 Roth conversion would be $14,600. So even though you can't Roth convert an inherited IRA, you can use the proceeds of the inherited IRA distributions to pay taxes on your own Roth conversion. This is an example of using the rules of the tax code to your advantage. This works well for somebody that's under the age of 59 and a half, because if you do a Roth conversion and you're underneath the age of 59 and a half, you cannot pay taxes out of your IRA because that would be deemed as a distribution, which would be penalized with a 10% penalty. However, paying the taxes on a Roth conversion with distributions from an inherited IRA is a totally legitimate way to pay the taxes. This small difference might allow you to be able to make Roth conversions when you otherwise wouldn't be able to. If you're under the age of 59 and a half and you want to do a Roth conversion, you will have to have cash available to pay those taxes. Using distributions from an inherited IRA may give you the cash needed to be able to do that Roth conversion. So can everybody implement this strategy? Well, no. You have to have an inherited IRA to be able to do this. But this is just an example of thinking outside the box to accomplish the goals that you have. If you want to work with somebody that thinks outside the box, that wants to help you figure out ways of accomplishing the goals for retirement, go to ChristyCapital.com. Look up at the upper right-hand side of the screen, you can click Talk to an Advisor, fill out the information, and somebody will be in contact with you. If you want to reach out to us by telephone, call the number on your screen. And if you don't get an answer, please leave me a message. This is Mel Stubbs. See you on the next video. We need to do the proper disclaimers. The purpose of this video is not to give specific tax advice or investment advice. We're going over general principles and ideas that can be used, and if used correctly, can save and avoid taxes. You're going to want to work with someone personally who knows your situation personally. So seek out advice from an independent financial advisor. This is for educational purposes only. I hope you enjoyed the video.